We're going to go ahead and get started. I'm going to introduce myself. My name is Gunner Five. For those that I have not met before, I am the Director of Operations here at Impact Wealth. And today we're going to be covering a webinar. This is the 10th webinar that we kicked off in a series that we started back in December of last year. So, flying through the year, we're excited for the topic today. Uh, that the CEO, Jim Teagarden, is going to be presenting on. We also have all of the previous webinars, the nine previous webinars that we've done available on our website. So impactwealth.com. We just redesigned our website that we kicked out a couple weeks ago. So feel free to head over to our website, impactwealth.com. Under the resources tab, we have all of the recordings to the previous webinars. So if you enjoy the one today, feel free to check out the previous ones. And as Jim is walking through today's session, if you have questions, feel free to put them down in the Q&A box down at the bottom. We will address those at the end. So without further ado, Jim, I'm going to kick it over to you to get us started.
Thanks, Gunnar. Hello, everyone. Happy June 26th. The year is almost half over. I hope everyone's enjoying their summertime. Um, and this is an updated version of a webinar I gave back late last year. And I decided to do it because I feel like our clients aren't thinking about things soon enough in the tax year. And because of a lot of the changes, specifically around the OBBA Trump tax changes from last year, there's a lot happening, a lot of changes, a lot of exciting ways to reduce your taxes. So just want to encourage you to, as Gunnar said, check out our new website. There's also a lot of video and other content around specific types of planning strategies that we use, types of investment strategies, et cetera. So hope you like that. I will be celebrating 30 years in this business as of around, I think, October of this year. So 30 years of being in the independent financial planning and investment business. Learned a few things, hopefully. And what we're really striving to do, as always, is to provide real results around tax reduction, lowering your risks, and preserving and protecting your wealth. And so, hopefully, this is some really good content. Make you think about things, and let us know if we can help. So, I'm just going to get going. We're talking about tax reduction strategies for high income tax earners. Disclosures. It talks a little bit about we are. Registered reps of Madison Avenue Securities. We offer investment advisory services through Senge Advisory Group, and I think for our clients, um, we're a small shop here in Boulder, Colorado, of about 10 or 12 folks. We've got a couple advisors around the country as well, but we couldn't do what we do without our partners. And I just wanted to talk about that real briefly. I am a founding board member of the Ridgeback Group, which is a group of independent financial firms around the country that own the bulk of our broker-dealer, RIA, and insurance distribution services. We're partnered with AE Wealth Management out of Topeka. We offer investment advisory services through Senge Advisory Group, which is about a $4 billion RIA. So we have lots of independent firms that are partnered with us that allow us, in our view, to provide services that are hard to find elsewhere. So let's jump into it. Taxes, taxes, taxes. This gives you an example of what high income earners actually pay. This is a $300,000 married couple, 500,000 and 1 million married couple income. And this just shows you federal, state, and FICA taxes and effective tax rate. So on a 300,000 of joint income, married filing joint, um, $87,000 goes towards federal, state, and FICA taxes. It's about 29%. $500,000 joint filers are about a 33% effective rate. So on 500,000, about 164,000 of tax. And a married couple with 1 million of income is up around 41%. There's also net investment income tax for most of these folks that isn't on here. But and I have to say, we have been in a fairly low income tax rate environment for quite a while. And most of the practitioners and clients we talk to believe that over the next 10, 20, 30 years, tax rates won't go down, they'll actually go up. So what do you do about it? And I often start with how many tax-free assets do you have in your estate? And most clients look at me with a uh, kind of a dumb look and don't know what I'm talking about. So we're going to talk about lots of ways to reduce taxes and use tax-free types of assets. So we'll talk about strategic Roth conversions, an update on qualified opportunity zones. The laws changed quite dramatically last year on those. Some energy investments and bonus depreciation type investments. Talk about hybrid cash balance plans for high income business owners. And we'll talk about how do you really plan around large retirement plan balances that are subject to ordinary income taxation. Um, Let's hit it with Roth conversions. I don't know why more people have not taken advantage of Roth conversions. I would say it's very rare that we get clients that have done very sizable Roth conversions. Over the last few years, clients have taken advantage of being able to contribute directly to Roths in their corporate 401k plans, which is great. But we try to help people from a Roth conversion standpoint understand the whys and hows to do it right. A Roth conversion is just a process of moving pre-tax retirement funds into a Roth account. So where future growth and withdrawals are 100% tax-free. So um, why does this matter? So we can lock in today's known tax rates instead of risking higher future rates. We can create tax-free income streams later in life, reduce our required minimum distributions, and overall increase our long-term net worth and tax-free compounding. So a Roth conversion will, when it's done, create taxable income. So it will create a tax burden up front. And we suggest that if you're doing a Roth conversion, that the money to pay that tax will come from non-IRA assets or non-401k assets. So outside funds. Almost always would we suggest that. Okay. And if you pay that tax today, you've got now a lifetime of tax deferred growth and tax-free distributions if you've held it longer than 5 years. And one of the things I think a lot of folks don't understand is that if let's say a husband has a 401k account, does a Roth conversion, that Roth conversion is tax-free throughout his lifetime. When he passes away, that Roth account goes to his spouse and it's tax-free for her lifetime. And then ultimately, when she passes, there is a 10-year period of continued tax-free growth or distributions so that effectively we might be dealing with a 30, 40, 50-year time horizon on tax deferred growth. And so this is a sample of a client just basically showing a 35% tax bracket client, showing a client converting $1 million today at age 60 and the benefits over time of converting to a Roth. And if you look at the very far right-hand side of the page here, we show the amount of taxes saved and the overall advantage on the amount of after-tax account values from the Roth conversion versus not doing the Roth conversion. And while this doesn't take into effect all the time value money calculations, et cetera, it does show you that over time, the longer you go, and this is assuming apples to apples on growth rates on traditional or Roth IRAs, and of course, reducing the taxable brokerage account rate by an assumed rate of tax. But if you look at that, a 40-year time period, so that's age 60 couple, let's say one of them lives until age 90, and then the kids or grandkids get the Roth for 10 more years tax free, that is a $10 million improvement in overall after tax monies over that 40-year period. Huge, huge advantage. And so I think some of the myths around this, we think a lot of people have not done the math on this. They think Roth conversions are only for young people. It's all or nothing. Maybe they just don't care that much. They don't want to take the time. One of the things that we've found is that what we do from a strategic planning perspective is say, hey, how do we budget this thing out? Maybe you don't want to do a huge Roth conversion this year, but how do we plan over time to be able to afford this Roth conversion strategy over the next 3, 5, 7, 10 years? And we do that in ways that allows us to keep our taxable income in the original tax brackets without increasing them. And it also allows us to plan for reducing the Roth conversion tax through lumping charitable contributions with donor advised funds or utilizing tax deductible investments like oil and gas or bonus depreciation or other types of tax reduction strategies to offset the Roth conversion. So that benefit I was showing you before didn't show you any of the benefits of actually reducing the Roth conversion tax, which is a big part of our planning. So we call that strategic Roth conversions. For larger estates, let's just say 2, 5, 10, 20 million in retirement plans, it is an even bigger problem. And we have some very specialized planning solutions around that. We'll just touch on that a little later. So, but in our opinion, everyone should be looking at doing Roth conversions and planning that out. It has a very large impact. And the other thing we see a lot of times, which a little side note, even if clients do have different buckets of money like Roth or tax deferred or taxable, most of the time they don't have the right types of assets in those structures to take full advantage of them. So talk about that a little bit later as well. All right, qualified opportunity zones. So when we say tax-free assets, a qualified opportunity zone, if held, or an investment inside of a qualified opportunity zone, if held more than 10 years, is a completely tax-free asset. And the Trump tax law changes last year extended qualified opportunity zones indefinitely, and made them actually even a little better than they were before. We're seeing an awful lot of folks with highly appreciated stock portfolios that don't want to de-risk because they don't want to pay the tax. Over the next 6 months, we are doing a ton of qualified opportunity zone investing to offset gains from taxable portfolios, or any taxable gains for that matter. Okay. So what is a qualified opportunity zone? It allows investors to roll capital gains into designated projects or investments to defer, reduce, and eliminate taxes on future gains. So this is a little bit of a visual here. Let's just say you sell an asset now. You reinvest money into a qualified opportunity zone investment. You're going to get a stepped up cost basis. We'll talk about that in a second. As long you have 180 days in general after you recognize the gain to reinvest into a qualified opportunity zone to get the benefits of a stepped up cost basis and the ability to defer capital gains taxes for 5 years. And then if you hold the investment for 10 years or stay in opportunity zones for 10 years, any tax burden on the QOZ investment will be taxed. There will be no tax on it. Okay. So why does it matter for high income earners? It allows you to defer large capital gains taxes. It actually allows you to reduce the taxable amount you owe. It can eliminate the taxes on any future appreciation. And what's happening now in the new law is that opportunity zones in rural areas will receive a 30% stepped up basis. Uh, urban opportunity zones will have a 10% stepped up basis. Rural opportunity zones will have a 30% stepped up basis. What that means is automatically you're going to reduce the capital gains from the sale of your asset by 10 to 30%. There's also some valuation methods that allow us to reduce those gains even further. So pretty powerful, and we're going to see more and more of this as things go forward. So encourage you right now to start thinking about opportunity zones, even this year. Um, Given one of the things you can do is, since you have 180 days to reinvest into an opportunity zone, we're just about at that 180-day mark in this tax year, so that in, let's just say, September, October, November, December, you want to go ahead and recognize gains, and then reinvest next year. You can still get the benefit on your 2026 taxes for the gains for this year by utilizing the 2027 tax rules for opportunity zones. So now's the time to be looking at them. And there's all kinds. There's real estate, there's energy, there's business, private equity type opportunity zones, et cetera. So, and you're going to see more and more of this. Given now that it's permanent, the initial opportunity zone legislation was a 10-year window that expired last year until the tax changes came into effect, making them indefinite. And I think this permanence, number one, it's going to provide a lot more capital to these various opportunity zones, and also there will be a lot more investment sponsors jumping into this now that it is permanent. Just touch on bonus depreciation. The tax laws that changed last year permanently set bonus depreciation at 100% rate. That means for certain capital expenditures, you can deduct the entire amount in the current year. That's led to a number of different investment strategies. Bonus depreciation was going down each year. The amount you could use is now reset at that 100%. You're going to see more and more investment opportunities taking advantage of this bonus depreciation concept to give you fairly sizable deductions based on investments of anywhere from 1 to 3 times your investment amount. So, um, passive activity issues here, but I do encourage you for the right folks to be looking at these type of investments as well. All right. In the interest of time here, oil and gas, energy investments, we love, love, love not paying taxes, and we love helping our clients not pay taxes. There's, there's very few ways to really reduce taxes in a safe manner. And the industry of the energy industry has had in the tax law advantages since 1913. Intangible drilling cost deductions, depletion allowances, and now the bonus depreciation uh, kicking back in. So oil and gas investing has been encouraged in our country since 1913, and is a very powerful way to reduce current taxation and to produce future cash flows that are tax favored, and in our view, get access to a commodity that's otherwise very hard to invest in as a retail investor. So, non-correlated asset with unique tax advantages. This is something our clients build up over time to really have a big impact on tax reduction. We're getting anywhere from, depending on the structure, anywhere from 30 to 90% immediate income tax deductions against ordinary income. This is especially good for W-2 earners who don't have a lot of deductions, but any high net worth client, obviously, this is part of their overall investment strategy as well. They've got to understand the investment, like the investment, and it must fit in with their overall plan. But if so, very powerful ways of reducing taxation. I'm going to kind of run through that quickly in the interest of time. Hybrid cash balance plans. This is a combination 401k profit sharing plan and defined benefit plan with a bonus of putting life insurance into the plan as an asset. For any business owner who's making over $1 million a year and has less than 35 employees, they should be utilizing these, in our opinion. They are very, very powerful from a savings perspective, from a tax reduction perspective. Um, and if used properly, can greatly amplify the benefits of this defined benefit plan by being able to turn some of these tax deferred assets into tax free assets later. So if you've got clients or if you've got people that are in this high income business owner bracket with not a ton of employees, let us know. Happy to guide you on that. Very powerful. We have clients, by the way, who are getting deductions of anywhere from 300 to 900 a year of tax deductible contributions to their qualified plan. So very powerful. All right, so now I talked about this a little bit before. We have a lot of clients, surgeons, high-level execs, business owners that have accumulated large retirement plan balances that are tax deferred, and they are now facing the piper, which is the IRS saying you've got to start taking money out and paying taxes, i.e., required minimum distributions. If you have this kind of situation, there are huge planning opportunities for tax reduction and overall wealth preservation and growth. And in that, this involves Roths, it involves life insurance, it involves profit sharing plans. So it's ERISA, tax. It can get involved in estate planning as well. So it's fairly complicated, but very powerful. This is an example of a client on the left if they don't do anything. So we build a model that show them on a certain amount of balances, both tax deferred and taxable, how much they will pay in taxes throughout their lifetime. So this one goes to age 96. These clients on a certain amount of their assets will pay about 3.3 million in taxes over their lifetime. That will produce about 2.7 of after-tax income throughout retirement, and there'll be about $5 million left after tax at age 96. So a combined couple through age, this is, I think they were 60 years old when we started this. If we do this tax reduction strategy, kind of a very simple baseline version of this, we're going to produce 3.5 million or 3.6 million, almost a million more of after-tax income. Their net cash balances after taxes will grow to 13 million instead of 5 million. So another 8 million of value. So all told, about 9 million of improvement of preserved capital on these clients. And they will only have paid 372,000 in income taxes. So almost a 10 times reduction in the taxable income. And so this is just another view of that same kind of assumption. So one of the things that we do for these clients, there's really a two-part mechanism here of uh, funding some assets with tax deferred and then conversions to Roths. In the last year or so, we have also been able to now put life insurance on children or grandchildren in the adults Generation One's profit sharing plans, and then distribute those policies after 4 or 5 years and add leverage to those policies for the kids. And so, from a wealth transfer perspective, this is by many measures even better than Roth conversions. So lots of new capabilities there. So again, for large retirement plan balances where you want to reduce taxation, increase the amounts of retirement income and the amounts to heirs. Bring it all together. So how do we really reduce taxes literally this year by tens of thousands or hundreds of thousands of dollars immediately? How do we build long-term tax-free income streams, help protect assets across generations, and accelerate the total net worth so you have more of an impact with your dollars and you keep them and direct them where you want them to go? I just want to hit on a little bonus information for this is really for higher net worth clientele, clients with large amounts of commercial investment real estate properties. Excuse me. Excuse me. Sorry about that. Or business owners with very large service-oriented businesses. Okay. And so over the last couple of years, we've partnered with a firm that is a specialty tax and engineering firm that are literally the experts in what are called tangible property regulations or TPRs. That was came out in 2014 in the tax code that we have found most clients aren't in compliance with on the real estate side, nor have they taken advantage of the huge amounts of lost deductions that they could be taking advantage of. We've had multiple clients where we've been able to help them come up with literally millions of dollars of deductions that they didn't know they had, lowering their taxable income dramatically. And then for service type companies over 50 million of revenues, the ability to defer revenues on an annual basis creates huge tax deferral and tax gains or tax reduction. So, would encourage you if you happen to be in a mode where you have a lot of commercial investment real estate, or you're a service-oriented business owner, let us know. Very specialty stuff, but advanced planning on the tax side. So if you're ready to build a strategy tailored to your income, business, and your goals, let us know. Call us, email us. We'd love to have an intro call with you to talk about what we might be able to do with you and help work together. So,
That's great.
Gunner, that's what I have.
Yeah, that's great, Jim. Thanks for walking through that. It looks like we do have a couple questions down below. So, the first one is, how do you balance tax efficiency with maintaining liquidity and flexibility, especially given the time that we're in?
Yeah, I think the big thing is when we're planning for clients, the first priority that we have to solve for, no matter what, is how do we provide the income they need to provide all of their living expenses, their taxes, their giving, everything, and really making sure that that is invested properly with certainty to provide that. If that's done well, then we have a very well defined, clear path on what we can do to some of these strategies. There are trade-offs. I might reduce my taxes a lot, but then I've locked up more money for longer periods of time. And so I think our bucket approach to investing, this is where we might have literally five different buckets or types of investment assets. And I think it really behooves you to have a game plan that really spells this out from an that from an overall, here's all my assets, here's my uh, cash flow needs, here's my income sources, and where are those coming from, so that you can really plan around this. And I think that's part of the reason we're so planning focused is make if you do that well, then it becomes very easy to understand those trade-offs and where they fit. So without that, I don't know really how you do it. You're kind of shooting in the dark a little bit. So that's kind of an answer, but I think it involves really making sure you've got all your ducks in a row and really have a unique roadmap for you personally that addresses all these concerns.
Yeah. Yeah, that's good. I mean, it really comes down to having a personalized plan for each individual. Not every strategy looks the same for everyone. So,
Yeah, and I think the other thing on that is really a cash flow model for each client that shows where the income's coming from, what's the taxation from those assets, and really budgeting those out. Most clients don't have that. They're kind of winging it. If they're in retirement or high net worth, they've got a lot of different asset classes. It's hard to understand that without really putting it together into a comprehensive cash flow and overall financial model.
yeah. Yeah, that's good. And one other thing I was just thinking about as you were walking through that is, a lot of the clients that we're working with have not explored a lot of the strategies that you talked about today previously or previously before meeting us. So, can you talk a little bit about the relationship that we provide here at Impact Wealth and how that may be a little bit different than some of the advisors that clients may have in their network already?
Yeah, I think it's important because most of our clients have competent advisors. They have CPAs, they have attorneys, I have investment folks, retirement folks, and they've done some of this planning. And by and large, most folks are coming to us saying, we don't have anyone that's really taking a look at everything from a comprehensive perspective and identifying gaps and opportunities and helping us plan for the future. My CPA is great, except for he's always looking in the past. His job is to help me reduce taxes from my prior year's income, right? They're not planners. Attorneys are not planners. Estate planning attorneys, by the way, I think clients, they do get into a little bit of planning, but they're really implementers. And most investment folks that we deal with are fairly limited because of where they are, whether it's a wirehouse or a big RIA, or they've just limited themselves to certain types of access or expertise. So I think um, we've recognized this. We've recognized this need, and we're really trying to expand and grow so that we can help more people do just what we're talking about, which is really have real solid results. It's not just, hey, here's my investment portfolio. How do I asset allocate this over time so I have a good 60/40, 70/30, 80/20 portfolio, et cetera. It's how do you really produce value added here in all areas, tax, retirement, estate planning, um, all of those things. So I think it's just a lack of industry being focused on it. And I think also just it's hard, It's like, why don't you go to the gym more? What, why don't you go to the doctor? Why is your blood pressure high? Well, you need a coach. Most people don't have a coach. And I think in this world that we live in, we got more and more and more and more information, and we have less and less people guiding us through that information and getting us to the real facts. And I think, we are a skeptical bunch here. We we uh, we want to know that things really work, and that so we spend a lot of time in due diligence and planning. And I think ultimately that's why we've developed this independent financial planning business the way we have. And most people aren't charging for the planning, quite frankly. We're charging for the planning work that we're doing up front. And then we're getting paid on the investment side of the house or insurance or annuities or whatever. So anyway, hope that helps. Anything else, Gunner? We're a little long
Oh,
here.
yeah. No, that's good. Yeah, I appreciate everybody joining us today. If you
Yeah.
have additional questions, feel free to reach out to me at gunner@impactwealth.com. Again, check out our website. We've got a lot of information on there as it pertains to the strategies that Jim talked about today. So impactwealth.com. We have the previous webinars on there as well, so feel free to check out those. The recording from today's webinar will also be on there next week, and we look forward to hearing from you soon.
Yeah, one closing point here, guys. I opened the webinar saying we're almost halfway through 2026. Don't wait until October to start thinking about taxes. Do it now. It takes a while, and you need to really understand and put the work in up front. In November, a lot of these strategies aren't available. We only have so much time and resources here. So if you want to save money this year, the sooner you start, the better. So with that, appreciate you all. Hope you have a lovely fourth as we celebrate 250 years in this country, this great country of ours, and blessings on you all. Thank you so much.